Welcome back to the channel. I'm the host, Osborne Foreman, and today we're talking about whether dividends are really pointless or even worthless, because it's a discussion I see a lot. There is obviously the dividend irrelevance theory. I'm not too interested in that. A lot of people have debunked that already. I'm just going to be talking about whether it's worth having dividend stocks in your portfolio and who really dividend income is for. And so if you're interested in that and you like the video that I'm bringing today, please drop one of these to help beat that YouTube algorithm, as it is much appreciated. Thank you. Before we start, I should mention this. When I first started investing in the stock market about a year and a half ago, well, at least started individually picking stocks, I invested primarily for dividends. Fast forward about a year and a half or 18 or so months, I now only really invest in growth stocks, but I do have 2 dividend stocks in my portfolio, although they are of a low yield of around 1 to 2%. My thoughts and theories changed on this over time, and I felt truly that dividends weren't worthwhile for myself. Because dividends are the idea that a company would pay out their free cash flow. Typically, we will talk about a payout ratio, which is how much of their earnings or their profits that they are actually giving back to shareholders in the form of a dividend. People look in a good dividend stock for a payout ratio of roughly less than 60%. The idea here is that if it's less than 60%, it means that they can grow it in the future, and it means that they've got room to grow it, but also invest some money back into the business to continue their growth. However, you may notice stocks like Amazon, stocks like Boohoo, other stocks that there's plenty of them around, you'll notice that despite having these high earnings, high amounts of cash flow, that they don't actually pay a dividend. And that's because they usually are higher growth stocks. These stocks can deliver shareholder value through primarily reinvesting that capital back into their own business and growing further. And this really depends on the industry or sector or even the type of business it is, because some businesses can do this very effectively. For instance, e-commerce giants like Amazon can easily reinvest the majority of that cash flow into more advertising, into more products, into more warehouses, and they can make a lot more money. The same applies to other tech giants, although perhaps let's look at a big oiler, an oil and gas business. Let's ignore the whole shift to carbon neutrality. Let's forget this. They're selling oil, likely either by the barrel, but they would likely be splitting it into their core elements using fractional distillation. These products will generate a lot of cash. Usually these oil companies, when oil prices are stable and high, usually are very high profit margin businesses. These businesses can therefore afford to give out to shareholders dividends, usually because when we're talking about oilers, they're usually one of the major oilers, meaning they are already massive global corporations that are very mature and have high amounts of free cash flow. Realistically, if they reinvest this money back into their business and they have a few more oil operations, it's not going to really change much about the overall business because, as I said, they're massive already. Them investing in a new oil site is hardly going to impact the profits or the earnings of a massive company getting billions in revenue and earnings every year. Instead, for them, it's more realistic and better for them to deliver shareholder value by paying a dividend. But as I say, other stocks, there are some growth stocks that do pay dividends too, and it really depends on the company. Dividends do provide a sort of enticement towards shareholders, and I can see the value in that. When I first started investing in dividends, the whole idea is that I wanted a passive income portfolio, meaning that I could invest in these stocks would pay me for holding them, and that during recessions or even bear markets, etc., even black swan events like we've had the last year with the pandemic, that they will continue to pay me income, and then hopefully 10, 20, 30, 50 years down the future, I could either be financially independent or live completely off of the dividend income in the portfolio. And so it's quite a cool goal to have, and you can really see that cash flow compound, reinvest those dividends back into the companies you like or you want to buy for longer term, and it creates a very nice cycle. Typically, you would look for companies with strong dividend histories and growth rates, although this is not without its risks. And it must be one must ponder if it's really worth it for these businesses to reinvest that money into their dividend or whether they should scrap it entirely. And I think this is really very much a case-by-case situation. As I've mentioned before, mature businesses, massive already. We're talking companies that are large cap stocks. Example would be Unilever, and I believe they're valued at well over £100 billion. and they pay quite a high dividend of around about 3 to 4% in yield, and it takes up a high payout ratio. For a company like this, they're a giant, as I said before, they're mature, them paying a dividend makes sense. Boohoo, a high growth, fast fashion retailer with profit margins around about 5% and ones that are really trying to make sales all the time. Since they have no high street stores, it seems silly for them to invest that way. So they're going to invest more in their business, more promotions, more advertisements, more social media branding, more partnerships with certain influencers. These partnerships should lead to more sales. Therefore, them investing a majority of their cash flow into either these partnerships or buying more brands, like they have done with their inorganic acquisitions of Debenhams and Dorothy Perkins, for example, they can generate a much better return on investment using it appropriately. I think when choosing dividends, I think they do have a point and a worth, but for a specific type of investor. And it really depends on what your time horizon and really what you're aiming to achieve through investing. If you're after some lower volatility stocks, dividends usually fit that category, meaning they're not going to move up and down as much, providing they're able to keep paying a safe dividend. Although, on the other hand, if you're after a stock that really will grow your wealth rapidly, and that means that if you've got a smaller amount of capital, you can build it up faster, dividend stocks typically aren't the ones for that. But they could have a place in a high growth portfolio. And if you'd like to sign up to my stockbroker FREETRADE, you can get a free share worth up to £200 when you click this link in the description down below. A good example of a dividend stock I hold in my portfolio would be Games Workshop. This is a company that has shown very strong growth in the last few years, but because they are vertically integrated, meaning that they can operate every part of their business model from the ground to making the product to selling it in their retail stores, they are able to maintain very high profit margins. And because realistically they don't need to reinvest that money back into their business, they're able to keep growing extraordinarily fast. Sure, if I really wanted and I wished for it, for instance, it wouldn't happen. But if I could, I would much prefer if Games Workshop did consistently put that money back into their business and grow. But ultimately, if the management is showing strength with the reduced cash flow that they're investing, it's still a very good sign to see. And especially with the relevance or the case of Games Workshop, they've mentioned that they want to grow the business organically and that they do not wish to make any acquisitions or disposals to really increase shareholder value, and instead just want to grow organically, increase the underlying financials and fundamentals. Games Workshop is a stock I picked because of their strong dividend and also large moat. For instance, their dividend growth in the last 5 years has been fantastic, and in fact, it rivals most of the companies in the FTSE 350. And then especially as it is a quarterly dividend payer, which is something I should mention. When looking at the frequency of dividend payments, the more frequent a dividend is paid, it becomes more of an issue for the company. This may lead into some forms of cash flow problems, meaning that at some points in the year, they may not be able to pay off their financing or debts, which isn't a good sign to have. And so whilst, yes, the idea of a monthly dividend stock would be great, getting paid every single month, brilliant, right? Not really. And it really depends on your overall situation and the business and how often they generate that cash flow. For instance, in a business that's quite cyclical and very seasonal, this could mean that in summertime, they're selling a lot of ice creams, for instance, but then in winter, they're not making as much money. But if they were trying to pay a quarterly dividend, it may come into some issues. And it also depends on your living situation. For myself, I'm only 21 years old. I don't have any financial overhead payments. For instance, I've not got a mortgage as I live with my parents, and the only reoccurring bill I have is a phone bill, which is pretty cheap as is. So for me, I can invest a lot of money and perhaps slide up the risk a bit more to go into more high growth stocks, so that at my current stage where my overall wealth is low, I could hopefully build it up faster, so that when I do have more wealth and I look to preserve it, then I would look to invest in dividend stocks, which is all about time horizon. So if you're nearing retirement or at an age where you're not sure how much longer you're going to remain invested in the markets, it's a bit iffy when we get to this. But the whole idea is, if you are in retirement, then dividends seem like a great way. You don't have to stress out about trying to sell 4 or 3% each year off and top slicing off of your portfolio, especially if it's a bad year and we're in a bear market and your stocks have lost 20% overall for your entire portfolio. Instead, having consistent dividend payers would seem like the best choice, especially in a low interest rate environment where you can't really park your cash elsewhere. Therefore, to me, it makes sense. If you are obviously in that older age category and you're looking to live off of dividends, then dividends have a good point. However, if you're young, you have a high tolerance for risk, and you don't really need the cash flow, you don't need to touch this money for at least 10, 20 years, then dividends may not be the one for you, because whilst yes, you could compound the dividends and reinvest back in those stocks, these companies could be growing themselves faster by using that money for inorganic acquisitions or just improvements to their general business. What do you think of dividends? Are they the one for you? I personally am a growth investor, so I feel that they have a little bit of a place, especially when there is a downturn in the markets and you do get some dividend income. It is nice to reinvest that back and get a good value on those dividends. And if you're interested in my free UK stocks to buy in August 2021, then click the card at the top right of the video.